All right, so welcome. I'm Konstantin Richter. I'm the CEO and co-founder of Blockdaemon. The reason why I'm talking first really is that we're trying to bridge blockchain application tokens and ICOs in one panel, which is a lot to pack in. I'm a serial entrepreneur. I had a couple of SaaS B2B platforms. AudioTube, Lookbooks, and Wiredrive was the last one that exited. I'm on the advisory board of Gem, MadHive, and a few other large-scale enterprise-y sort of B2B blockchain platforms. Have been in the space for a couple of years. Very focused on being an entrepreneur, helping entrepreneurs build companies and scale them. We've conceptualized Blockdaemon really as a play into growing with a very slim layer in the stack while we see blockchain take up in the enterprise. Still very early stage, very nascent. Arun is going to talk a little more about that. It's a nodes as a service platform, a little bit like a Roku of blockchain. Has a venture-backed. We're currently out here in the valley. The other reason why I'm here is I just recently completed an ICO for the Proof of Existence Protocol 2.0, which ICO'd on August 8th. And we maybe naively choose to do it all ourselves. And so I have some lessons there and perspective of what worked for me. By no means am I a blockchain expert. I'm a doer. I'm very experimental. Not overly smart. I know how to build things and how to get people to believe me long enough until ideally they see a beneficial outcome. So there's much smarter people on the panel who might know more detail. I know how to scale a company. And so what I wanted to talk about is, just because we don't really know who's in the room, let me see if this works. Just really quick introduction to blockchain. We're going to talk about very briefly what that is. I think all of you guys have heard what it is, immutable ledgers. The way I like to think of it, coming from a more enterprisey place, is in the absence of blockchain, you have two choices when it comes to your database and peer-to-peer networks, which is you can have a centralized institution in the middle that everyone connects to authenticate transactions. That's one way to do it. Problem with that is that you create a sort of monopolistic sort of non-innovation friendly entity. The other alternative is you connect everyone to each other, and that requires a lot of data reconciliation. And a blockchain sort of connects the two and spreads them over the whole network with cryptographic keys, which is a really important sort of feature. So, and that's kind of sort of the promise of blockchain is specifically within the transaction economy to allow peer-to-peer networks to function trustworthily, immutably, and transparently. So there's, as you've seen over the last couple of years, a lot of promise around it, how to scale it up. There've been a couple of different venture cycles going into blockchain. There's a couple of interesting things to note. One of them is that I think a lot of the first generation blockchain enterprise companies got a lot of venture backing. They're currently all kind of sort of in B2C round land and experiencing some troubles now that the ICO land comes up, where there's a promised land for a lot of capital for no equity. So there's a consequence for those companies when it comes to capitalization life cycles that we're going to touch on really briefly. I do want to highlight that it's very early days. I kind of say blockchain is sort of kind of 1997. There's people who say it's 1994. It's definitely early. We're kind of stuck in between the chasm of early adopters and early market applications called POCs. A lot of the startups in the space are bogged down by proof of concept work and pushed into trying to generate revenue, and that hasn't been very successful. That's why one of the reasons why a lot of the protocols like ICOs is because it allows you to fund and really kind of front load R&D without having to adhere to these sort of very tight venture circle and dynamics. The one thing I'd like to say is that Amazon, Yahoo, Google, all those guys were founded in and or around the mid-90s. So if you play that game, you can assume that maybe one of those companies in the blockchain space already exists. And the question is, who is that? So just sort of some background. And then one of the big questions I get a lot is, how new is it really? What does a blockchain really do? When people talk about decentralization, or distributed databases, there's way more powerful tools than blockchains to run distributed databases. There's a lot of things blockchains don't do well at all. A lot of them actually real-time transactions, memory and storage on blockchain is very poor. Energy consumption on blockchains is very high. There's been a lot of issues with scalability around blockchain that have been addressed, and you've heard of some of the forks. Bitcoin Cash is one of the results of that. For example, Ethereum was one of the results of that, of having a blockchain that actually is more able to handle enterprise related issues. One of the key parts that I like to point out is that the cryptography is very, very important in the blockchain landscape, and that's really kind of the key differentiator when you look at database infrastructures. And I don't want to get too technical, but there's a lot here, and there's a lot, as I said, that blockchains don't do well. So why is it so important now? I mean, a lot of the things that I've seen is that nobody really at this point, we're all in agreement that blockchain as a protocol is going to be very, very powerful and revolutionize a lot of our transactional database platforms. What we don't know is what is the primary discovery mode and what's going to be the dominant platform. So there's room in the market for some extraordinary powerful participants, and people are throwing capital that way to kind of make sure they're backing the one who is going to actually enter in those particular and sit in those particular squares. So, a couple of points what blockchains don't do well. Block size limitations. 1 megabyte so far limits the amounts of transaction per second. It changes all the time. You know, there's a lot of work done there, but when you hear people talk about real-time transaction markets using blockchain, you're probably onto something a little faulty. Proof of work, which is not suitable for enterprise scale. Proof of work is the way blocks are authenticated and mined. There's proof of stake, other protocols coming down that lower network costs. Standards are all over the place. You hear that there's a bunch of consortiums coming out to kind of try to figure out how to actually build metadata, how to build consensus models and ways to sort of interact with blockchain. And then there's diverging interests. The economical issues around blockchains, tokens, and what really motivates the players who participate in the particular market. Those can be very, very different. So there's quite a few challenges. But, you know, everybody kind of does it. All the major large companies, I mean, R3 actually is one here, Tim is here. You know, there's, I mean, I don't know how many participants, 70 or something, but a huge number of big banks are part of that. You know, Digital Asset Holdings has an enormous amount of investors that are all large blue chips, Hyperledger project, Ripple. There's a bunch of projects here with names and logos on it that shows actually a surprising depth of companies interested in pushing and furthering the current blockchain landscape. So the thing is real. And now I want to talk a little bit about Bitcoin. Bitcoin is two things. It's a protocol, it's also a currency. And just currently what we've experienced in the industry is you know, kind of unique in those sort of last 6 months. So I always kind of differentiate between the people that have been in blockchain and ICO land before the last 6 months, and then the people who are in it since the last 6 months. You know, there's been an interesting trend there. There's a lot of factors why Bitcoin rose up to the level it went. But I wanted to put it on a timeline and point out a couple of events when it started. 2009, trading started 2010. We had around sort of December, late December 13, sort of kind of Bitcoin went somewhat mainstream. People started to invest. Coinbase, I think, came out in 2014. And so people in exchange, actually exchanging Bitcoins for dollars was a little easier. And so ever since, we've had more and more people going in it. The ICOs played a little bit of a part here. The other big part is that a lot of the larger institutions and crypto funds started to come in and actually build hedge funds around cryptocurrencies and have portfolios that hold Bitcoin and Ether and Litecoin and others. And so more and more people started to engage with the market, and here we are. I stopped in May 17, so it's actually still way higher, even though we had a little bit of a dip. But so Bitcoin is by far the longest and oldest standing protocol, and drives a lot of the current hype that you're hearing. So one of the numbers I've heard is that protocol currencies created over 10,000 millionaires. So I'm just kind of sort of throwing that out there. A lot of the guys I worked with, like in 2012, 2013, folks who sit on you know, you bought like 1,000 Bitcoins, and you know, we're kind of sort of happy with that. That looks like a pretty smart investment today. So there's a bunch of guys who you know, made quite a bit of money, and they're crypto enthusiasts, and they keep on trying to exchange their tokens into other tokens. And so that's one of the main other drivers for ICOs, is normally how you drive tokens, and the value, how that works is you offer Ether or Bitcoin in exchange for other tokens. So there's a bunch of names here: Ripple, Ethereum, Litecoin, and the sort of current valuations based on compared to what they started out as of. So you can see the quite a big appreciation in the market. It's a pretty popular slide. Took it from the internet. So ICOs outraised VC's investment year to date. Very popular. I'm sure you've heard it. You wouldn't be here otherwise. My kind of reading is that I'm actually surprised how few successful ICOs there are compared to the hype it gets in the market. There's been around 35 to 40 that I think have been executed and done in a way that raised a substantial amount and haven't been hacked. So it's actually not that many compared to the hype that we've seen. May this year had 5 ICOs. I think right now we're close to 10 a day. So there's been an amazing acceleration of that process in a very, very short period of time. From having done one, current best practice, Civic in general is to be seen as, that was a very smooth ICO. I have no comment about the token, just the process of the physical sale. We've all had to learn our lesson on how to actually build a sales platform that handles thousands of transactions into a digital wallet across multiple currencies with a dynamic cap on top that sort of caps everyone off at a very particular limit. I haven't heard from an ICO who went seamlessly. Most of the sites tend to crash, or you end up chasing some Bitcoin addresses down the line, but it's a very nerve-wracking experience when you make one. And the other thing is that the legal regulatory structure, and we're going to talk a little bit about this, and there was quite some news about China over the weekend, also makes it actually a very, very challenging process. So having done an ICO, my simple words of wisdom are, the money is relatively real and the terms are amazing. So what's been fun for us to see is that when you work with a law firm through the terms and conditions, the sort of one-sided term sheet you get from the lawyer to protect you gives the investors very, very little. If you actually read it, you'd be surprised. Most people in online sales actually never read them, but it really leaves them with pretty much no recourse for anything. And the money comes in Bitcoin and Ether. There's a big question on how you actually liquidate them and what the tax implications are, et cetera, but it works if you do it hard. But the one thing I have to say is, from my perspective, ICOs are actually really hard to do. I'm amazed that people talk about ICOs in a light-mannered fashion. Ours took us 3 months, and we spent so much time sitting with legal, incorporating companies. You have to have an opinion. Do you go to Switzerland and Singapore? What happens to your US entity? How you deal with the SEC, the regulators? We actually spoke with them. Is it an equity and a security? How do you, all the documentation required in terms of a global market, in terms of translation of Chinese, Russian documentation. We had an open Slack. We were across all the different community channels, engaging with the audience, publishing code on GitHub, doing a bunch of bounty programs around code reviews, talking to all relevant crypto marketing vehicles. I would say it was definitely one of the most taxing experiences I had, and far, far more complex than any raise I've ever done for any of the other companies I'm in. So I'm always like, it's not easy to do an ICO right. And it's also a very costly thing to do because there are so many ICOs that and it's so hard for people to do proper due diligence on them. The current way it's done is mainly reputational underwriting. So people throw their names on particular projects, there's certain big whales and people in the industry, and that sort of kind of people follow that, right? So very few people are actually able to review the GitHub code and actually have a real opinion about the protocol that's being launched. And so what tends to happen is, because there haven't been that many successful ICOs, it's a little bit pay for play. There's a couple of law firms that do it really well. I'm sure Fenwick is one of them. There's a couple of auditors that do it really well. There's a couple of marketing companies that had a good track record, so everybody's sort of kind of hitting up the same guys. So it creates a weirdly misshapen market economy. The other thing that's very popular is giving whale investors discounts in a pre-ICO, which actually also isn't really nice for the overall investors. So there's sort of also the trend of kind of pre-selling most of the ICO and then do a crowd sale on top of it when most of the large discounts already all kicked in. So definitely definitely a dodgy ride. The other thing I've seen is what I find interesting. It's a little bit hedge fund 1998, and again, this is just my experience. But I see a lot of large blockchain and crypto funds put a little money in equity, reserve a pre-ICO token allocation, and then make a secondary market commitment. And you need a market maker if you want liquidity and volume. There you go. So it's an interesting. There's interesting returns to be made, but the scales. If you're an investor that actually doesn't have any knowledge within the ecosystem, it's a pretty rough bet to know what works and what doesn't. I think the other thing to that actually in scamming is a huge factor. What was interesting for us is like you throw up a public Slack, and what happens is once you do the ICO, people will just throw up, pretend they're an official announcement, throw up a wallet address, and the fun part around crypto is you wire your Bitcoin in there and it's gone. So the best practices around scamming have also evolved relatively quickly, but it's hard. If you I'm curious, who actually has invested, try to be part of an ICO in this room? So it's an experience I really urge you to make because it's actually really interesting. You'll learn a lot. You can put in hopefully $100 or something, but the configuration needed, the wallet integration, etc., actually teaches you a lot about the process. And I always tell people when they say they want to raise money on an ICO and they have never done an ICO, it's like raising money and not having a bank account. You're not really familiar with the infrastructure of what that looks like. China. Yeah, what can I say? I mean, China is a huge market. Most of the mining happens there, but regulatory infrastructure is changing rapidly. Was the line I had before the weekend. Since then, ICOH, ICO Info, a bunch of those guys got barred from issuing any ICOs. I think everyone is awaiting more detail around what goes on, but it looks like China really kind of sort of put their thumb down on ICOs. Specifically for Chinese tokens and Chinese exchanges. They've actually today published a short list. I think there's 50 or 60 names on it. If your ICO is on it, good luck. And so those were great tools, very active. Most of the projects had used them. We used them. We had ICOH, good little typo. We had ICOH on it, and we're actually returning investor capital for those. The Chinese are not messing around, and we don't want to mess around. We're all about following the regulation as long as it exists and is somewhat clear. Regulation here is fairly complex, but it's coming. Altcoins will get a serious shave. My perspective, and again, I'm not a lawyer, is that I think a lot of the exchanges are going to have some ugly surprises. A lot of the pressure of regulation and legalities tends to be focused on them, and rightly so. There's a lot of fraud in this space. As a sort of blockchain enthusiast, I welcome that absolutely. We're preparing another ICO, and we're actually filing for full, we're doing the full Reg D kind of thing, raising from accredited investors. The first one I've done, we've excluded American investors. We had a sort of little button you clicked, and then we had a IP blocker. And we try to not have any American investors come in on the physical crowd sale to avoid getting in trouble with the SEC.
Did that work out?
Huh?
Did that work out?
Yeah, I mean, we filled it very quickly. I think we had like 7 minutes or something. But yeah, I mean, I think you don't want to mess with the SEC under any circumstances. And the SEC actually is a great thing because they really, they're there to protect consumer interests. And I think the good protocols and projects have nothing to fear. If you raise money to actually, and we did a capped ICO with a small amount actually, we raised 10 million, which, I mean, it's crazy that in today's landscape that's nothing, but we actually had a tangible roadmap. We have developers working on it. This is kind of what we intend to spend over the next 2 years to actually enhance the protocol. And so we feel pretty confident. But we had actually, a high 6-figure amount spent on legal opinions, right? So we did a lot of legal work to make sure we are adhering to the regulation as much as it existed at the time. For us, in the middle of our process, the DAO ruling came out, which was interesting. A lot of law firms had a lot of opinions about it. From my point of view, it was a little bit of a nothing burger. DAO was always a security. They never said anything else. No files were charged, mainly because they returned all the money to everyone, so nobody lost anything. But what the SEC said in my interpretation, is you know, some ICOs are clearly securities and should be regulated. Some might not be. We're reserving the right to figure out which are which, and we're going to keep an eye on them. And so, you know, it's important to take it serious. So, with that, just a couple of enterprise highlights. A couple of things that happened. Spotify acquires blockchain startup Media Chain. Toyota pushes into blockchain tech to enable the next generation of cars. R3 raises 177 million from a bunch of guys. So I just wanted to throw that up there because we do want to talk about blockchain here as well. And we have Tim here, so it'll be interesting to hear what he thinks about the actual stage of the blockchain market. But there's the token in crypto land, and then there's blockchain as a sort of physical protocol gaining traction. So they're a little interconnected, but one of them, you know, there's a certain flavor in crypto economics that makes it sound a little dodgy, and blockchains as a whole don't necessarily deserve that. So I kind of wanted to end here. The way we're going to do this panel, everybody gets around 5 minutes, talk about their company and what they do, so you guys get an idea on who they are. And then I have a couple of questions, and I'm sure it's going to be a lively debate. We're going to open it up for Q&A for like at least a good half hour. So, you know, we get to talk about some interesting stuff. So, do you want to start at the end? Why don't we start with you?
Hi. I'm Ryan Straus. I'm an attorney at Fenwick in the Seattle office, and I am co-chair of our payments practice, and that is what houses a lot of our blockchain activity. I've been in the space since 2011, the broader Bitcoin space, of course, and have experienced all of the. It's been a crazy 6 years. Let's put it that way. That's about all I have to say right now. I'm sure I'll chime in as it goes.
Quick question: are you guys providing counsel to ICOs, for example? Like, yeah, is there a big one you've worked on?
Yeah, we don't. We sort of make a habit of not talking about our clients in the regulatory space.
Okay, good.
Tim?
Yeah.
Hey guys, thanks for having me. It's good to see you all. A lot of faces I don't recognize, which is good, or maybe bad. I don't know, maybe you guys all go to jail or something. I'm only half joking. So, I work for a company called R3. I'm the only person on the West Coast. Raise your hand real quick. Who's heard of Arson? R3? You would? Okay. So we work on the. If you think of the blockchain world as a big umbrella, half of it's focused on cryptocurrency stuff, doing ICOs and altcoins and stuff like that. The other half is, well, actually it's probably smaller than half, is working on enterprise-related activity with institutions. That's the world that we work in. In my actual role, I talk to companies, projects, startups, and in the last 2 years, I've spoken to about 500 or so different companies. We don't do anything with ICOs yet. Every single day, I kid you not, I get an email asking if we're going to do an ICO and how to buy that ICO. So there is a world for that, but that's not what we're doing. So just to give you a brief idea, we're about a company of about 130 people, primarily from in New York and in London. As you just mentioned, we raised a lot of capital in May, about $100 million, $107 million from a bunch of banks, because we're working on solving problems for banks. We have a platform, and again, I don't want to spend too much time on this. We have a platform called Corda. You go to corda.net. It is not a cryptocurrency platform, but it takes some of those ideas inspired by that world, and basically is an implementation put in for financial institutions that are regulated. And again, we can talk about that during Q&A if you'd like. Corda.net is open source. Some quick ideas about what it is and is not from an architectural standpoint. Rather than going into it, I'd like to say that the most salient point is it doesn't broadcast everything to everybody. Satoshi and Vitalik and people like they're building actual blockchains for in the anarchic world where there is no one no one vetting who validates these systems. We're trying to get around it, or actually create a way of of creating censorship resistance. And to do that, you need to propagate everything to everybody. So you have backups, including one for your phone. But if you're working with really sensitive data, confidential data, you don't want your competitors to have it. So it doesn't make much sense to replicate that information to them and it's sitting on their node. Because at some point, maybe they figure a way of being able to reverse engineer whatever cryptography that you're using or even some kind of encryption method that you may have used. So Corda, from the get-go, only sends data to the participants involved in the transaction, plus maybe a regulator. So that's I would say that's the biggest takeaway with Corda. We'll give you questions and comments afterwards. So thank you for your time.
Great, so my name is David Gobaud. I am the co-founder of Mobius. It's a new blockchain company. Broadly, we are working on decentralized commerce. So the idea is that most tokens today are used for trading. They're not really used for commerce. And what we want to do is create a token and ecosystem that actually makes decentralized token-based payments a reality. And we look at this in two stages. We look at this in terms of commerce today and commerce tomorrow. So we're working on, there's three parts to it. So the first, you can think of it as Stripe for blockchain. We have a live API right now. It's up, developers are using it. It's mobius.network/docs. And we make it very easy for developers to use tokens. So someone mentioned in terms of technology, I'd say we're at about the early 1990s. It's sort of analogous to 9600 bit per second modems were just released, HTML was just created. That's sort of where we are right now, right? Interacting with the Ethereum blockchain, it's pretty hard. Make the smart contract, issue the transactions. We provide a simple Stripe-like HTTP REST API to do token transactions as payments. And then what we're developing now is a universal login protocol. So, for example, if you're making a website that's selling tokens and you want the token to be used as a login protocol, we make that easy to do. The next thing we have, and this is also already live, you can see this. How does it?
There's a PDF.
Oh. How do I go to the next? Oh, that's cool. So our D App Store, so this is also already live, and developers are using it. People are already putting apps on here, and the idea is that you can use our token to submit payments. So broadly, the idea is that the app economy is predicted to be $6.3 trillion in 2021, and Apple and Google are using their monopolies to take a 30% cut on a large part of that. So the idea is, we can charge significantly lower fees, say 10%. They could give users a 10% discount and still make 10% more. And once again, we think that the reasons why no tokens have really been used for commerce is it's a two-sided problem. It is too hard for developers to use and too hard for consumers to use. So on the developer side, we have our simple Stripe-like API. And on the consumer side, we now have this very easy-to-use app store where people can send payments to different apps. And this covers commerce today. And what we're working on in the future is we look at it as, data is going to be the new oil. And the idea is, how do you commercialize that data? And the idea is much of this data is going to come from the billions of IoT devices. So a simple example is, you have a self-driving car that needs a new tire. The idea is that it will advertise in our marketplace that it needs a new tire, and then tire manufacturers can submit bids, and the vehicle can automatically pick the best one and drive over and go buy the tire. So it's facilitating machine-to-machine commerce. And our token, in this case, would be used for our proof-of-stake Oracle protocol. It's actually patent pending technology. It's in our white paper that you can read on the website. And also, this isn't in the slides, but in terms of the marketplace, what we've also done is we have a Stanford PhD student that left the program who's working with Paul Milgram, a preeminent auction theorist on auction theory, and what we've done is, in our white paper, you'll see a bunch of auction methods, but recreated for the blockchain in a decentralized way. And we've already filed provisional patents for this too. And oh yeah, so here's actually another, so this is like the self-driving car example, but here on the left, you could imagine this is a semiconductor machine, some part breaks down. You know, if your fab line goes down, you're losing millions of dollars every hour. And the idea is, once again, you facilitate this machine market where the bids can come in and the machine can automatically buy the replacement part, find the closest one or the least expensive one. And the next step would even be, imagine a stream of data from the semiconductor machine, and these smart contracts could actually process that data to even predict when the part was going to break. And so here's the team. Let's see. So yeah, it's me. I did computer science at Stanford, then law school. Cyrus, my co-founder, also went to Stanford, and Monas is the PhD student. We got to leave the program to join us, also from Stanford. We have two great advisors, including the co-founder of Stellar and Ripple, Jed McCullough, and Jackson Palmer, the creator of Dogecoin. And for Jed, so one thing that's a little unique about us is we are going to be on the Stellar network, so we are a Stellar token. We are not on Ethereum, and the reason why Jed connected with us was he saw that for what we are doing, Ethereum could not support our transaction volume. So Ethereum only runs at about 7 token transactions a second. Stellar runs at over 1,000. Ethereum is also very expensive. Right now, transactions cost 20 to 30 cents. Transactions on Stellar are almost free. And the last thing is Ethereum has a very large attack surface due to its Turing-complete programming language that it supports. So Stellar, on the other hand, supports smart contracting capabilities, but it's not Turing-complete. So those are the reasons why we chose to go on Stellar. And we also did a token pre-sale. It actually sold out, unfortunately, before it went public. And we have our public sale scheduled for November 8th. So let's see. This. Yep, thank you very much. Look forward to questions.
Alrighty, well, we figured that out. My name is Arunram Kalaiselvan. I'm the CTO of Blockdaemon. We are a blockchain infrastructure startup. I promise I'm the last person standing up showing you slides today. After this, it's going to be a conversation. I met Konstantin about 6 years ago. We did our first exit at Lookbooks, and then I went off and did a whole bunch of infrastructure work in ad serving and IoT, and then we came back together about a year ago and started building this advertising platform for OTT. And there, while exploring blockchain for a private consortium we're working on, I realized it was unnecessarily painful to set up and deploy blockchain networks. And it's not as simple as any of the infrastructure we're used to working with so far, primarily because when you start doing planning for your infrastructure, you have to take into account the kind of space you need, the kind of processing power you need, and then you have to take into account everyone else is going to be joining your network and figuring it out for everyone and not just you. So we figured, hey, if we could come up with a super simple system that can help you make those decisions, help you figure out what you need for your networks long time, and make it really simple to add other people to the blockchain networks that you spin up, we definitely have something there. Well, that's what we do. We are making it really easy for you to decide which blockchain you want to be on, what kind of servers you want to be on, and bring people over and make it easy for people to invite to the network. And finally, we said, hey, if we are able to orchestrate all of this, we can then go on and figure out what kind of requirements there are for pretty much every network out there, and maybe in the end up reducing some of the associated costs, because all of this is really hardware heavy. At the moment, we're sort of in between the blockchain layer and between the platforms. We help you spin up your nodes. We help you install the blockchains. We do pre-configuration. We also let you go from, you start on Amazon, you think it's too expensive, you want to switch to something else. We actually help you port your stuff from one network to another, so you're not bogged down by one. USR looks like this at the moment. You come in, pick the blockchain you want, tell us where you want to deploy it, and we will do the rest for you. And at the same time, we're then able to monitor all the nodes on your network, tell you if you need to switch hardware, upgrade it, and if there's anything else that you need around administration for your blockchains. So with that, I'm gonna stop this and we'll get on with our conversation.
Cool. So we're going to move to questions. So I have a couple, but just because I heard you talk. Stellar, great response around Stellar. I was ready to ask you the same question. Stellar is a super interesting platform that I'm curious, how much are you raising and as a total, and then is Stellar are you using that for liquidity and volume? Is that going to be the trading platform you're going to be on, or what is the plan there?
Right, so we don't really look at it as fundraising. We just sell our tokens, which are our product.
Right.
And I think, so in terms of exchanges, we also don't solicit any exchanges.
Smart.
But Stellar actually, one of the things is it actually has a decentralized exchange built in.
Right.
And in terms of how much product we'll sell, we don't know. The market will determine that.
Yeah, and then just an interesting point is one of the reasons actually getting on an exchange, I think Poloniex hasn't listed anyone in 6 months. A lot of the projects nowadays offer bounties to get listed on exchanges, but you can't, if you are officially soliciting an exchange, you're generally considered to be a security, so somehow that's a little frowned upon. Is that something you've found? And also, who are you using for the physical sales platform? Is Stellar going to run that sale for you, or are you working with somebody?
Yeah, so for a bunch of these reasons that you mentioned, I think you're going to start seeing a lot more Stellar tokens. So the big one is, you don't, in terms of exchanges, like I said, it has a built-in decentralized one that I don't think can basically be shut down. In terms of what was your second question?
What was my second question? It's a good question. It's the audience. My question was if you use it for liquidity and the physical platform of the sale. So the day you're actually running your ICO, who built that for you?
So Stellar is actually building some type of token sale platform that will make it easy for us to accept Ethereum, Bitcoin, and of course Lumen. And probably some.
But let me then maybe push it over to you over there. Would you say that? To the statement, like, is that actually true? Like, I've heard that. I have no idea that if you're soliciting exchanges, kind of means you're a security. Like, what's your view on like security exchanges, and kind of getting when people come to you and say, hey, I want to do an ICO. How do I get on an exchange? What do I need to take care of regulatory wise?
Yeah, it's a longer conversation, right? You're asking like question 20. And there's a lot of assumptions built in the previous questions that I might not be willing to concede. But the first step, I think, is to decide. Well, one, what I always ask prospective clients is why. One, what do they have built? Are you selling a token, or are you attempting to sell a token for future functionality and to finance finance said functionality? Because if the answer is yes, definitely tending towards the likely to be a security side of the equation. The other thing I ask is, if in the event the answer is we're selling tokens to finance future functionality, my question is often, why are you selling current tokens for functionality that doesn't yet exist? And thus the sort of, I don't like the SAF terminology, but the idea of selling future tokens for future functionality as a security is frankly our preference, unless the functionality is already built. I mean, it's sort of like you can make it simple if you. This might date myself a little bit, but it's like financing the production of an arcade game.
What's arcade game?
Yeah, I know. See? Makes sense. You guys know what arcade games are? No. All right. So financing the functionality. I can't use an online analogy, so I'm going to use arcade games. A big arcade game that accepts physical tokens. I can use this.
Yeah.
Hello. Yeah. All right. All right. So it's like financing the development and production of an arcade game that doesn't yet exist by selling tokens for that arcade game. I mean, that's a securities offering, right? I could go through how we test factors, but it's a security, or likely to be deemed a security by the SEC, or the sale of which is likely to be deemed a securities offering by the SEC. Furthermore, if you're selling a token that for said functionality, it's going to be more likely to be deemed a security if it's not native for that functionality. So if you use a non-native blockchain for for functionality that doesn't exist, you're essentially in you're in the higher risk category. So that's sort of how we bifurcate things.
Can I ask interject a question? What's so bad about being a security? Like, can you talk about what is the difference if you are a security?
There's nothing bad, good or bad.
In terms of,
except, from my perspective, right, we have a different view of things. But when at least we have a very well established securities regulatory regime. The general rule is you have to, if you're offering a security, you have to file a registration statement or have an exemption from the filing requirement. And one of the more common that you referenced is doing a securities offering as a private placement in compliance with Reg D. So there's nothing fundamentally difficult or other than you have to limit the investors, the nature of the investors. In many cases, you'll limit it to accredited investors. You also have to limit the total number of purchasers. If you have 2,000 or more, even in a private placement, you would be required to file the registration statement. So yeah, there's different rules.
Yeah, no, fascinating, and it's super fascinating because I hear that so many people are so fearful around securities, and it's actually if you do it right, it's absolutely possible.
Yeah, we don't see a lot of them done well. I mean, look, one answer is that it's a new space. Tim and I have talked about this for years. That only works for so long with regulators, right? And
They'll catch on.
Yeah, I mean there's elements that are new, but we're talking about a pretty separating people from their money is a pretty old concept.
But one thing on the token, if the token itself is a security, would that limit the free transfer of
Absolutely.
tokens? So that,
Yeah.
I think, is actually the big problem, for us with our...
So, just real quick, I mean, there is a distinction between the token being a security and the future token interest being a security. And so, yeah, as a general rule, you wouldn't want a token that is a security because that would restrict transferability. However, when you sell token interest in a private placement, you would do so. You would instead sell future token interest, the right to receive a certain number of tokens, and that is easy to restrict. Once the tokens are issued, they would then be freely tradable.
Interesting. And then just a quick, just to loop Tim in here a little bit. I'm curious, because obviously R3 works with a lot of banks, and you see, is there any, has the token economy changed any of the sort of inherent mission of what R3 does? Is that something that resonates with the customer base that you have, or as you've mentioned, previously? Is that something seen as really completely different as, this has nothing to do with the blockchain variability of that you're working on? And maybe just describe like what's the use case you're working towards actually with R3?
Yeah, a lot of questions there. So let me see if I can unpack that. On the ICO front, we as a company have officially said, at least our CEO has written a couple op-eds and spoken to in media that we were in favor of continuing to treat things that act like a securities under the existing regulatory regime. And we think that there's a lot of good regulations there to protect investors and consumers. So our official position is pretty much what Ryan would basically represent. In fact, for what it's worth, Fenwick actually represented part of one of the law firms during our fundraising. As far as the use cases that we're looking at, it's funny when you go to a lot of fintech events, and I was counting it up, and I mentioned I've been to about 100 or so in the last about 3 years. And if you listen to people on panels, I won't say who or names, but the majority of the panels are people pitching B2B related products without actually doing any requirements gathering to find out how to actually implement that in enterprises or institutions. And as a result, you end up with a lot of hype. So all of you here, raise your hand. All of you want to get rich quick, right? Yeah, okay. That's why you're here. You're waiting for us to tell you which coin to buy, and when to buy it, and when to sell it. I'm not going to do that. To talk to me,
It's because he didn't buy Bitcoin.
yeah, I didn't buy Bitcoins. So fundamentally, if you're working with the B2B enterprise world, it's going to be get rich slowly if you do, because the sales cycle is longer. The types of stakeholders that you need to get signed off on things are takes a year to even find the right people. So the world that we work in, let alone the use cases, are very different than what ICOs and the cryptocurrency world are. And I think the two can coexist. I don't want to throw shade on the cryptocurrency world. I think that they can build something maybe useful, but it's probably not going to be for enterprises because they have different requirements.
Yeah. Thanks. And Arun, actually, from the Blockdaemon side, I'm curious, actually, do you have any thoughts, Arun? And I know we've been debating that a lot in terms of, do you have any ability to predict network and infrastructure requirements for the blockchain ecosystem over the next year? Like, is there any trends? Like, what do you see in that landscape?
That's a pretty loaded question there. Primarily, if you look at it, just looking at the public chain space, in the Bitcoin land, you have about 10,000 nodes that are publicly pingable. But with Ethereum, it's sort of shot up over the last couple of years, and it's about 3 times that. It's about 25,000 nodes out there. And it makes it really hard to start predicting and planning for enterprise infrastructure, especially if you're talking about private networks. Like most of the assumptions that I have for Blockdaemon is that if you're a consortium of let's say 10 different people or companies getting together, you're looking at one node each, and then depending upon what kind of blockchain you're working with, what kind of configurations you're doing, you might add on a couple of Oracle nodes on top of it. And again, it really comes down to what kind of blockchain, what kind of infrastructure you want to work with. But that said, looking at the trends over the last couple of years, I think we're going to be Bitcoin's public nodes at least are going to grow the same way as they've been going on so far. So we're looking at about 15 to 20,000 nodes by the end of next year. And with Ethereum, we're looking at about 30 to 40,000 nodes. And that's just on the public chain. So.
Right. And actually, Tim, do you want to talk briefly difference between public and private? Like just a probably standard question you hear quite a bit.
Yeah, so the reason I hear it a lot is because I literally popularized that term, permission versus permissionless. I wrote a paper over 2 years ago. That's how I got my job at R3, is because it became the most widely cited thing. And so all these panels out there talking about permission versus permissionless, public versus private, it's based off a paper I wrote. And I think the whole term is this complete bullshit. Because it shouldn't be a marketing term. An airplane is not better than a helicopter. They both have use cases. So for somebody to say a public chain or anarchic chain or whatever is better than an enterprise chain is hokum. Because for those who don't know what hokum means, it's BS. Because fundamentally they are built for different requirements. So I think I've been very consistent in that view for over 2 years, and I think I have been proven incorrect. You have an entire enterprise world focus on the needs of what we would consider very boring things, but it's very useful for some of these institutions, and I think that will continue. And I don't want to throw too much shade at the anarchic world. These decentralized platforms have their growing pains. Maybe they'll fail or maybe they'll succeed, but they have the different use cases. They can't do the same things. They can't provide settlement finality, for example, on central bank digital currency because they weren't designed to actually provide identities for those who need legal recourse. That wasn't part of the deal that Satoshi created. He didn't care about solving problems for back offices within banks. And I think, again, both worlds can coexist, and if you want to continue arguing about which one's better, this is a dumb debate.
I don't actually think there's even a debate there. It's
Yeah, I think that's pretty, I totally agree. They're totally two different use cases.
We're done here, let's go.
Yeah. One quick question for Mobius before we go to Q&A.
Can I reserve a spot there?
Yeah, totally. You didn't mention how much you're raising.
Right. I said the market will determine that.
Okay, so you're okay. All right, so you're an uncapped.
Yeah, I mean, we're still working on the final token sale structure, but it'll probably be similar to Filecoin, where we average all the money that comes in the first hour and do some tiered thing.
Right. Okay, interesting.
Yeah, I was going to say one of the interesting distinctions, and I remember talking to Tim when he was incubating, I guess, that taxonomy, is that one important distinction between private and public blockchains is that public blockchains create, there's this distinction between, and this may be nerdy lawyer stuff, but hey, I'm a nerdy lawyer, so there's this, thanks, Sam agrees. So there's this distinction between property rights and contract rights. Property rights being, I own these shoes, and that right is good against everybody, right? Everybody in the world. I could also have contract right. I could rent these shoes, right? And my rights would be good against my counterparty. The idea being that the public chain, and actually what's to me interesting, and I'm not saying one's good and one's bad, but what's interesting to me from a legal perspective and what creates a lot of the use cases proposed is the idea to have property-like property rights like rights in digital things. That is to have rights against everybody in the world with respect to data, for example. If we're just, I guess it's the difference between owning MP3 is a terrible example. We don't have any great examples of things with digital things. What?
Domain names.
Yeah, domain names is the one clear one. There's a great case, Kremen v. Cohen. It's actually it's interesting. I like mentioning it at panels because it's about the sex.com domain name, and basically it established a three-part test for determining when intangible right can be treated like property. And the overall point, I guess without digressing too far, is that public blockchains create the possibility of having property rights in digital things, whereas private blockchains are by their nature creatures of contract. And so they're fundamentally different things.
Cool, thanks. Before we move to Q&A, let's quick one. What do you think Bitcoin 2025? How much for Bitcoin?
You're asking me?
Yeah, everyone.
Yes.
I mean, when I started Bitcoin, you saw that chart, 2011. I'm not very good at predicting Bitcoin price.
Tim.
I'm not good at
He's not very good either.
40,000.
40,000. Okay. Arun?
Well, we bought Bitcoin at $10 back in 2011, doing shady deals down the street in New York City. So
Thanks, Arun. Yeah.
Is that why
So-
you're right now?
yeah, I think in about the 40 to 50,000 range is what we're looking at.
Huh, okay. I think it's going to be much higher, but I'm willing to be challenged on it. All right, let's go to Q&A. Let's see what comes through.
Hey, Jameer Khan, crypto enthusiast. I've always been wondering, we've got the Jobs Act. Can't we use the Jobs Act to allow non-accredited individual investors to buy a token that is a security, or do they have to pass a new law for that?
Yeah, you asked the lawyer.
I mean, the short answer is it's possible to create, to leverage the Jobs Act. Yeah, the limits are low, and frankly, the ability to restrict transferability from a technical perspective, it's there, but no one wants to do it. So compliance is extraordinarily difficult, and frankly,
Why don't they want to do it? Is it because of the complexity of getting it right, or?
Look, it's the same reason that people use things, and I'm not, as Tim has said repeatedly, throwing shade at your mention about the geo-filtering IPs and taking sort of remedial steps to limit U.S. involvement. That being said, each incremental step you take to limit involvement and limit transferability limits the market, right? And so people do not want to, restrict transferability to sort of whitelisted addresses or and again, I think it does. I think that's one way to put it. That why you don't want to comply because you don't want to do the things because that'll infringe upon your ability to raise a lot of money, right? And avoid compliance effectively. But the other way to look at it is it fundamentally alters the type of token you can or coin you can use in the sense that, like I said about the private versus public distinction, if you start restricting transferability, all of a sudden now you're the counterparty, right? And all of a sudden it's starting to look a lot more like a property right than a contract right than a property
But
right.
do you think the legislation is going to evolve with that? Because obviously,
No. I don't know. To answer your question, I don't think in this space, having been in it as long as I have, I don't think anybody should expect legislation that's going to be favorable to this space. I just think that's unrealistic, and frankly, planning for it leads to bad consequences.
Cool.
let's do an ICO and lobby for it.
Good luck.
All right, Crash.
Happy to represent.
My understanding through the example that you have mentioned and what I've read is that blockchain powers Bitcoin and powers also a lot of other cryptocurrencies, or maybe some form of contract for financial transaction. Most applications of blockchain are designed for these purposes. Do you see also applications, especially in the enterprise space, for non-cryptocurrency application or non-financial transactions, or not?
So hey, raise your hand. Who knows anything about trade finance? Trade finance? Jeez. Okay. Supply chain management? Okay, cool. So about 2 weeks ago, IBM announced that they're working with about 10 different food manufacturers, including Nestle. Everyone's eaten Nestle chocolate, I believe. If you haven't, it's delicious. I do not own any equity in Nestle. And so the idea here with what IBM's trying to do, and there's a startup here in San Francisco called Ripe.io, and one of the co-founders actually used to work at R3. Happy to introduce you to him. The idea here is if you go straight from the farm, you take digital signatures along the step of the entire supply chain. The theory, the ideal world is you'll be able to see exactly who could or could not be abusing that system, whatever vendor it might be, where the actual break took place. Now, expecting that to take place anytime this year is unrealistic. That's why you have organizations like IBM trying to put this together, or startups. The trade finance world is the same way. We as a company are working on 3 or 4 pilots related to the same idea. Google the term trade finance, and it'll just blow your mind how old and antiquated this topic is. But fundamentally, it's moving agreements, legal agreements or contracts between different institutions and parties. It doesn't actually necessarily involve the movement of cash, or in this case you were asking about cryptocurrencies. So if you're looking about enterprise or B2B use cases that don't involve that, I'd be happy to chat with you and give you presentations on it, but there's many use cases that don't involve that.
Identity is also a really big one in the identity space. There's lots of use cases.
And I think with data, the same thing with Mobius and the IoT devices. How do you get that data into the blockchain? I think it's going to be a proof of stake system. It's reputation based.
Hands up, who knows what proof of stake is? Oh, not bad. Do you want to explain it real quick?
Yeah, especially how that might apply to data.
Right. So very broadly, the idea is a reputation system. So if you have an IoT device that's sending data into the blockchain, if through the community or some voting system it's determined this device is giving fake data, it would lose some of the tokens it had to stake to sort of play in the system. Whereas if its data is very valuable and purchased, it would receive payments for it instead.
There you have it.
I have a question. Yeah, that over weekend and China have big, event, right? They shut down the blockchain, and but today, China Central Television, Channel 13, they say that it's a temporary. In the future, if they implement the right safety measure, then they will reopen the IPO. Yeah. So what that will affect our, blockchain ICO in the US. Yeah.
I mean, yeah, you go.
I would say we don't know yet. It's so recent, right? We don't.
Were you planning of raising on ICOH or ICO Info or any of those platforms?
We were just starting to get introductions to them. I mean, we were also going to a conference in Shanghai, and it actually got canceled. Yeah. So they're taking a very serious.
Because the government say that that's illegal fundraising.
Right, and just broadly, I think, I think that wording is very strong and will stifle innovation. And I think the U.S. SEC seems to hopefully be going down the right path with the DAO memo, where the DAO token wasn't really a surprise. It was clearly a security. It was basically a share in a venture fund with voting rights and profits that would return to the token holders. Whereas I believe there is a significant difference with a product token like we have that's very similar to a virtual arcade, and you go buy tokens.
I'd be happy to challenge that if we have time. Okay, so I'll actually defend the PBOC's actions just for the moment. PBOC is the People's Bank of China. They issued, along with 7 other agencies, saying we're going to ban this. What they ended up doing is they investigated, and they found a lot of these ICOs were investing in other ICOs. So basically, people were spending Bitcoin and Ether to buy into an ICO, and then those people were then taking the money and then buying into another ICO, and then they're buying into another ICO. It's completely absurd, and it's going to lose, since there is no disclosures about who these insiders are. You have a lot of self-dealing, self-trading, insider trading. So maybe, going back to your point, maybe 10 years or 10 months from now, at some point, they establish some set of laws. I can only guess, but I think that they banned it again, I lived in China for 5 years, I worked there, I love China, but we saw what happened with P2P lending and these wealth management products in 2013, 2014. They did the same exact thing. They were offering 13, 14% interest on investing in these private shadow banking facilities, and then those invested in others, and those invested in others, and then it led to billions of dollars of losses. So this is not the first time this has happened in that country, let alone in other countries. So I totally respect the fact that they're trying to genuinely protect investors and consumers. Maybe they change it in the future, but I certainly don't want to protect it for time.
Yeah, and I think that's kind of how it's going. What's interesting when I've been fairly intimately involved in ICOH, just because it's been a crowdfund platform that we've used for some ICOs, and we're returning funds to investors. I think what you see in China a lot is there's also a lot of tokens that clearly are copycats and a little bit fraudulent and stuff. I think so. There's been a little more abuse than I've seen elsewhere. My kind of again, and legally it's like impossible to predict. I think it's a good idea to probably put a lid on it. I think for all. Actually, I have a question. to Ken. Do you think there's actually a legitimate, like, is there a legitimate reason to do an ICO for a lawyer? No, to Ken. Ryan, sorry, Ken. Who's Ken?
Kendall.
Yeah, as you call me.
Yeah.
So, I mean, I sort of have, I mean, I've said this for a long time, the terminology sucks, right? ICO, really? I mean, it's dumb on so many levels, and doesn't put a target on your back at all, right? But so, I mean, I do think that there's a genuine distinction between, you know, companies with business plans and even businesses, which is rare in the space in some cases, right? For actual businesses to raise money to using tokens or open source technologies that have actual use cases and adopters in mind. You know, I think there's no place for ICOs, companies created to engage in ICOs. I think that there's no place for the sale of securities to you know, and you know, the raising of money by way of selling tokens for functionality that does not yet exist. I mean, I think that's, unless you want to do it in compliance with the securities laws.
Okay. Yeah, no, interesting. All right, another question, the gentleman over there.
So my understanding of blockchain is the blockchain is an ownerless public data repository. That's how I see it. Now, for building these ownerless repositories, should we use own infrastructure, own computing and storage infrastructure, or ownerless computing and storage infrastructure for trust and integrity?
Well, someone owns it, right? At the end of the
No,
day.
not necessarily. You can design something which are ownerless. And shouldn't they be ownerless, which is contributed by the community, okay? But nobody owns it.
You mean like Linux or like what
nobody
would you?
can censor it. Nobody can block it. It's always available for a token. So because right now you have mining pools who do take strategic decisions on which blockchain to support, on which blockchain not to support, which folk to support, which folk not to support. So tomorrow there may be a very important public repository, very necessary, like identity public repository for some place in India or Africa, but there may not be any infrastructure available for it basically. So how do you solve this dilemma of availability, integrity, and trustworthiness with their own infrastructure?
Oh.
Because blockchain is an ownerless repository. Nobody owns it. Nobody owns Bitcoin. Nobody owns Ethereum. Nobody probably owns Stellar. So shouldn't these be built by ownerless, completely ownerless infrastructure?
So I would actually challenge that statement. There's a funny quote from a guy named Dave Birch who said, clouds are just a funny way of saying that somebody else runs that system. So if somebody runs the system, they're responsible for it. And so again, going back to this dichotomy between a quote unquote public blockchain or a private blockchain, whatever, at the end of the day, somebody's running that infrastructure. And for example, in the private world, they have SLAs, they have service level agreements and guarantees by contract about how the uptime will take place if it goes down, who's at fault and stuff like that. The quote unquote anarchic world of Bitcoin and Ethereum are purposely designed not to have that kind of contractual relationship, because if you did, then you could sue them, take them to court, and censor the transactions.
Yeah, to put it another way, you know, we were talking about property versus contractual rights, right? And the way I view it is again back to the public-private and that dichotomy. What I think Tim is saying is that property rights don't depend upon counterparties, right? Your rights are independent of your rights against Ethereum, right? Your rights, your whatever it means to say I have a Bitcoin, it doesn't matter what any company says. Now, property rights aren't they aren't unlimited, right? I mean, in other words, governments can take away your property rights, as governments can take away your rights to participate or hold crypto assets. Of course, it's happened time and time again. But you know, what I think the important distinction is whether there's a counterparty, and the positive to having a counterparty is that you have recourse, right? The negative to having counterparty is that you, instead of having property rights, you have contractual rights. And so it's a question of enforceability. And oftentimes, I mean, if what I have said a lot is if your rights to Bitcoin or Ethereum or Litecoin are not property rights, then there are no rights at all, right? Because good luck trying to enforce them.
But just to add to that, someone still invested a certain amount of money. There was be it energy costs, be it hardware costs. So essentially, when they get rewarded for mining the block, they technically do own it. So I will challenge the fact, well, that you said it's ownerless.
Are you saying they own the block?
Well, no, I'm not saying they own the block, but they still own the tokens that they got.
Oh, okay.
Yeah,
Yeah.
that's all I'm saying.
No, but he's saying the infrastructure, the protocol.
No, my question is, should the ownerless repositories be created by ownerless infrastructure? That's what I'm saying.
Well, that's what I'm saying.
Does the deficiency right now currently I see in the market? The mining pools are owned, which is not good for ownerless repositories. Anyway, we can read my point.
Yeah.
Yeah.
That's my theory.
Yeah,
Okay.
let's talk about it afterwards. Absolutely, I definitely want to talk about it.
My question regarding the kind of ICO or token sale was that so in the past we saw many white paper. They are developed by not by the established like a startup. Usually, which means they never raise like a Series A money from established VCs. And so right now we are seeing like a kick. Established company are coming into the token market, and some established startup which already raised Series A funding and also consider using the token to raise non-diluted equity, non-diluted money. So what do you comment about the like going forward, like whether the like a more do you see more like established startup will coming in and enter the market?
If I can just a couple of quick comments, because yes, you will. I think there's a bunch of very established blockchain companies that just have to handle the reality of ICOs being available, specifically in the sort of VC sort of level. There's a bunch of big companies out there that probably, if they would go for ICO, could raise a lot of money at very, very lenient terms. So I think, I mean, I know in fact that a lot of the bigger, well-established companies are thinking about it. I think you're gonna, within the blockchain space for sure. I think you see a lot of venture. I think the complexity legally in order to actually do it right, to actually have a company that actually has equity and investors and then do a token raise on top of it. And I'd love to hear your thoughts, or you know, creates a certain complexity. What I've seen done is that you reserve like 10%, 20% of the token for equity holders and pay it out in prorated shares. So structurally, the integrity of a token raise on top of an equity investment creates a different challenge to that. But I definitely see that happen as well. I mean, and I don't think they're worse than, you know, if there's a good case for protocol tokens, so there's a lot of great blockchain companies out there that took venture funding before ICOs were sort of as common as now. That totally, you know, for them it makes totally sense to raise money for a protocol token. So I don't think there's a yes or no answer, but I'm curious what you think about the legalities of it.
Yeah, I mean, typically the way these are structured, and in fact, Kick, I believe, you know, you're not actually buying tokens from Kick. In Kick's case, I believe they're selling current tokens, not future tokens. But you're not actually buying tokens from Kick. You're buying tokens from some third-party foundation, the Kin Foundation, that's powered by Kick. I don't know exactly how it's going to work. I think that the real question is why the blockchain, right? If you have a compelling answer to that question, whether if you're, you know, established or have a compelling use case and reason to leverage the blockchain by using a token, I think you know, there's a great, you know, there's an opportunity out there. I think that those are less common than we're being led to believe with 10 ICOs a day, which is actually, to me, a shockingly low number given that I have probably 25 ICO potential clients a week I'm talking to, which is kind of exhausting, but I don't want that to put a chilling effect on anybody. I'm happy to talk ICO to any of you. You like that? But I think that what's happening is you're seeing projects. I'm hoping this is the trend that will continue. You know, more solid projects with solid companies and solid use cases for the blockchain. I'm nothing against Kick, but I'm just not quite. Okay.
Yeah, I'll take the detracting point on that one, as usual. So raise your hand, who's ever heard of Kick before you heard about the ICO? Who'd ever heard of it? Okay, who'd ever put it on your phone before? All right, so Kick is really just a zombie company that should have gone bankrupt, but they're now going to be propped up because of this ICO. That's really fundamentally what's happening. They're going to get a bailout from retail investors to buy this stuff, and maybe they succeed. But like, the detracting point, counter argument to me is saying, Tim, in many countries, you're allowed to gamble. Gambling is a math tax. We know there's only a certain amount of people. Again, fundamentally, the debate about who could invest and who's allowed to get money can turn back into who could be an accredited investor. Is it only 3% of Americans, those who are already wealthy? You know, this obviously turns into a philosophical discussion. But for the purposes of Kick, I don't understand what they need an actual blockchain for. It seems very much a jury rigged on. I wish them good luck. I don't know anyone there. If you're in the audience, you would be happy to talk to you afterwards. I would really be skeptical for the use case around needing it for a messenger. So another company 2.5 years ago called GEMS, G-E-M-Z, on Telegram. Anyone heard of them? Wow. Okay. So like one guy. They did a ICO on top of, I think, the Counterparty platform, and they're the most. I wrote a paper for our company internally, looking at these ICOs to explain to our management who's doing what and who's failed. I looked at about 20 from 2013 and 2014. If you look at the advertised KPIs that they were trying to fulfill, almost everyone fails. Like, they didn't actually build these features, but all the coins themselves were worth all-time highs in May when I wrote this, because everyone just is get-rich-quick, speculative mania. I'm sure that will continue to happen. I'm sure Kick will make money with Ken or something like that. But at the end of the day, if you look at GEMS, if you look at people trying to do stuff with Messenger, it really doesn't add much more value, in my opinion, as a curmudgeon.
So what use case could you see, Tim?
Well, I mean, I could see one.
Okay.
I mean, so in China, my understanding, WeChat is used commonly for payments. What if you can use this token for the payment method and avoid fiat? Right.
But then you have token stability issues. Like none of these coins have some way of stabilizing their value.
You just take the real-time price of the token and just.
Then if you're just exiting back into fiat, then you're just using BitPay's data for just actual tokens.
You don't have to exit out, right, to do the transfer. You could, let's see. So if what's backing the current payments is credit cards, you could have lower fees, right, if you use the token. Like, that's one.
Uses WeChat right here.
Yeah, everyone.
Okay, we all use WeChat. You all connect it to your bank account, right? Does that cost you anything? No, it's like a debit transaction. So like I don't see how they would have a market inside of China. Sorry.
Well, not in China, but I mean, what about in the U.S. or other countries where that type of payment system hasn't taken off, right?
So raise your hand. Who's heard of this website called AngelList? AngelList. Okay. If you type in the word payments, how many payments companies are there? I believe the last time I checked, it was like 3,000 or something like that. A huge number. How many of those will succeed? Like, it's going to be a power law. You're only going to have like 1 or 2%. So we have a very disaggregated system of payments in the U.S. Many banks operate their own payment system. So trying to create yet another payment system, no offense or anything like that, it's very difficult.
No, I mean, it's definitely difficult, but that doesn't mean it won't work, right? I think it will be a power law. I mean, Kick already has a great base to launch on, right? They've got millions of users. They're probably well ahead than any of the others, or many of the others.
We can argue about that.
I think one of the things I kind of want to say also, what is interesting, I see there's always it's actually very hard to build blockchain companies or any company and get them to raise money and stuff. It's always very easy to have a negative viewpoint on it, right? Like, because it's a very, very, you're talking about 2-3% of a success rate, right? So I think specifically in a sort of super demanding ecosystem like this, it's very, very difficult. Most companies are going to fail. It's easy to shoot holes in concepts and reasons why not to do it. I think what you're going to find if you choose to become, for example, an entrepreneur in this space is, you'll spend most of your money probably talking to lawyers who will advise you mostly against probably what you end up doing if you're smart, which is you're constantly balancing constantly balancing, but because you're constantly balancing risk, right? The difference between an executive and somebody who just follows input is your ability to walk the line between navigating a very complex, different set of demands, right? And some of them will push you on one side of the platform and one on the other. So I just sort of kind of find it in ICO land, it's, you could probably find a reason to dismiss most ICOs. I've seen like really large ICOs happen on the chart I have, like there's some there with a lot of money, it's very easy to dismiss them, But then on the other hand, you can make an argument, it's the same when you talk to the EOS guys about why is it an uncapped, like, their kind of viewpoint on uncapped sort of raises. And there's some validity there. Why do you exclude people? People can make their own choices. So ultimately it's a market-driven infrastructure, but I do kind of want to highlight that because it's specifically in ICO land, there's no way you're going to do an ICO that everyone is going to agree with. That's not going to happen. Like there's always somebody who's going to tell you this isn't the right token, this isn't the right use of a blockchain, you're doing it the wrong way, there's just so many different inputs. It's actually very, very difficult. And I'm curious actually if you have what's your experience there working with all the different sort of sets of advisors when you navigate that landscape?
Yeah, many phone calls with lawyers, but we don't pay them unless they have a plan. I think we finally found one. I did a lot of research myself. I actually think the biggest issue that at least U.S. companies may not be thinking about product token is the taxes. Right. The big difference with an equity raise is it's tax-free. It's tax-free. You sell a product token in the U.S., the IRS is default 35%, and then the state taxes, like half the money might go away. I think everyone early on focused on, whether or not it's a security, and the SEC did its thing, but the thing that may come back is the taxes.
See, I think, if you had been around, from 2011 to 2014, the big issue we were talking about in this broader space is, interestingly, an issue that we haven't discussed at all, is anti-money laundering laws, which most ICOs are blatantly disregarding. And sort of, whether, we used to have these conversations about whether a particular token or coin was a centralized or decentralized virtual currency, which, if you're dealing in blockchain-based tokens or coins, FinCEN, the U.S. Department of Treasury, thinks that you're a virtual currency regardless of whether you're calling yourself an asset or a product or whatever. You are going to be a virtual currency. And so the question is, what it comes down to is whether you have the power to both issue, and some people debate this, whether it's or and take the token out of circulation. If you do, it's a centralized virtual currency, and by virtue of being an administrator, you are a regulated entity required to comply with the Bank Secrecy Act, which is our nation's anti-money laundering law. So you don't hear about this much anymore. In fact, I haven't seen it's been a long time since I've seen a discussion about whether ERC20 tokens are centralized or decentralized. I suspect that's going to be more important than the securities conversation in the next 3 months.
Yeah, that's actually what our lawyer, Tom Brown at Paul Hastings, who I think is pretty well known in this space, that's one of the things he actually flagged today. But yeah, and maybe you have a view on, like, if you go to an arcade, GameWorks, and buy some tokens, my question is, are those covered by the DSA, and if not, why not, and then why?
So there's actually some clear guidance, and actually if you look, so in 2013, FinCEN came out with their first, FinCEN's the Financial Crimes Enforcement Network, federal agents with guns, a Bureau of the Treasury, is responsible for administering our anti-money laundering laws. In 2013, there were a bunch of people having a similar conversation, right, about tokens, arcade tokens, gift cards, and Bitcoin, right, and where Bitcoin fit. Is it more like a closed-loop gift card or is it more like a Visa-branded debit card that you buy? The gift card, if you can't get cash back, and if certain limits, thresholds are complied with, you are an issuer of a gift card is not required to register as a money transmitter or money service business. So there were people in the space that made the argument that Bitcoin was more like a gift card than it was like a Visa-branded debit card, which is clearly, was problematic at the time and remains problematic. But FinCEN actually, in 2013, in their first ever statement, they made this distinction between prepaid, which is gift cards, and virtual currency. And the distinction is prepaid can only be denominated in fiat, whereas virtual currency is not denominated in fiat. So hypothetically, if you issued, if it was a one-for-one relationship between credits or tokens and the fiat value, and you put the fiat value on everything, and it was stable, then maybe you'd get away with making the analogy like the arcade token. But unless you do that, you're not going to get away with it.
We're going to run out of time, so final question. Gentleman over there.
First of all, thank you guys for taking your time out here, man. You guys really did well. I got a lot out of it, so thank you very much for that.
He charges money for it, so if you want. He'll do 2 hours.
Tim, you need to go and stand up. I'll pay some money to watch you. All right, so my question is around, first of all, Mobius. David, congratulations. You guys did really well. I followed the pre-sale. You guys did really, really amazing. But the one question I had, and myself being a blockchain developer, one of the things I see is people come to me and they ask me what platform should I build on?
Yeah.
And there's promises being made across the board. Waves has made some promises. Nobody's seen anything come out of it. Stellar, obviously you're in good terms with Jed, so you got some good insight into that. But I guess the question is where's besides the money and besides the value of the crypto token itself, where's the incentive for each one of these people to actually go bigger, better, and do something amazing? We keep talking about this analogy with the internet in 1994, 1997. There were incentives. It just doesn't seem like, people are just buying crypto tokens, it's just going up and down. People are comparing to fiat. So I guess it's a two-part question. One is, where do you guys see that world go as far as the maturity of the platforms, individual platforms? And then the second one is, futuristically, do we ever see the disconnect between fiat and crypto and just live in that crypto world?
Right, so there's a few things here. So in terms of the platforms and I guess why do people build them? Why do people work on Ethereum or Waves, or why are we working on Mobius? So if you think about it as the early internet, it's really exciting. Blockchain, I think it's an amazing story, right? It's a fundamental technological innovation, and we don't really know who created it, right? That's sort of rare. It didn't come out of Silicon Valley. At a very high level, what does the technology enable people to do? It allows groups of people to self-organize without any central authority, right? I think there's a reason Satoshi, the person or group of people, knew that they should be pseudonymous, because the technology at its core was a great breakthrough and dangerous to powerful, rich, central organizations and people. So I think that is what excites a lot of the developers in the space, right? We're building really amazing technology. That's what excites me about Mobius. We're really excited about building the decentralized NASDAQ for data, okay? In terms of, I guess the other question was, well, why do people buy cryptocurrencies today? Well, clearly people think they're gonna get rich. We're trying to change that, and I think a lot of people are and want to make real products. And then if you look at, which platform to build on, so that's one of the things we're doing because there are so many of them. We're trying to provide this universal protocol layer via our easy-to-use API to make it easy for people to move between them. Because you're right, we don't really know which one. Ethereum, in some sense, might be like AOL or MySpace. We don't know. It's very early. I think there's a lot of great advancements that are going to come out. As of today, how do you choose what platform to build on? I can tell you, we looked at some of the we looked at Ethereum and Stellar. And we picked it because Stellar was faster, cheaper, and more secure. And for what we're doing, the way we're using our token, we didn't need a Turing-complete programming language. If you do, there are reasons to be on Ethereum, but the truth is, given the speed and cost of Ethereum today, you can't really build any dApps. This is why what we're taking is a progressive decentralized approach. So with our dApp store, right, the website is centralized, but we're slowly building in decentralization aspects, starting with payment, then login, then we may decentralize parts of the App Store. But one of the reasons or big theories that we had in how we're developing Mobius is actually create stuff, put it out there so people can evaluate the product before they buy the tokens. We wanted something actually live, and that's what we did. And we're continuing to advance and develop the platform every day. We have some new products coming out that we think the Ethereum Stellar communities are really going to be excited about. I would say, yeah, it's very early days. People are excited about it because of the technology, and we don't know, Tezos, EOS, Waves, Ethereum, we don't know which one is really going to dominate. I think it's early days. It's really exciting.
Can I answer his question real quick too? Not real quick, it's going to be long-winded. Eloquent, lots of very interesting Latin words. So there's a term, if you want to Google it in economics, called free entry. And anytime you have a market in which you effectively have no preventative measures to prevent anyone to come in, you have a flood of entities coming in. At one point, for example, thin film solar film companies in the US were numbered over 100 until you had consolidation and washout. And I remember a number of you probably are techies, so you remember the cloud frenzy 10 years ago. Oh, I could build you a private cloud. I could data center right here. And who did that actually? Anyone want to admit to doing that? So I think that will continue to take place here because not only, even if we have massive crackdowns here in the US, if you have these cryptocurrency exchanges outside in different regimes like Isle of Man or Gibraltar or something like that, I assume that you'll have people just flood to wherever they could quote unquote arbitrage, which is unfortunate because I think that really potentially could hurt consumers. But back to your point, I think it's really difficult. I don't envy you trying to decide what platform you're going to build on because every single promise that you have, what's that quote? Extraordinary claims require extraordinary evidence, as I think Carl Sagan said. To vet 1,000 different platforms or 25 a week, is this impossible? I looked at 500 companies in the last 2 years, and I would say 80 to 90% of it didn't have a good product market fit and had to end up pivoting like 2 or 3 times. So yeah, I'd be happy to chat with you offline about which ones I think are good, but I'm certainly not going to stand here on stage and tell you, this is the exact one you need to build, except for Corda. Corda.net, check it out.
Arun, do you want to?
Just to add to your question. It's basically the same thing with any tech, right? You're a developer, I'm a developer. How do you decide what to choose when you start building something new? You don't know. Usually, you pick something up, you start working with it, and if it works, great. If it doesn't, you go find something else. And that's essentially what most developers will have to do in this ecosystem. Like anytime someone comes to me and says, hey, I want to build a blockchain application, I go, why do you even need a blockchain? Right? And that's a question you should definitely ask yourself before you start doing blockchain applications. And that's my 2 cents there.
Yeah, I think we've got to end, unfortunately. We're 15 minutes over time. So if you guys have any other questions, seek out the individuals, chase them down. I gotta go home, have dinner.